We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve St. Angelo of SRSrocco Report.com. Thanks for joining me today, Steve. How are you?
I'm doing great. A lot of interesting things happening in the energy and metals market. So it's always great to come back and talk with you.
Well, that might be the understatement of the century here, Steve, that there's lots of interesting things to talk about. Of course, maybe we should start by talking about the idea that capital expenditure or reinvesting in the oil fields that we do have, the energy that we do have, might not be able to actually save and get us back on track to where we need to be or where we have been for energy production.
Hey, Tom, you started on the best question, because this is what I see a lot in the industry, on the media, and even on social media like Twitter. The one objection about the energy industry, the problems that we're facing, is that there's not enough capital investment. It's those lousy climate changers and green energy. And so because they're getting politicians to look at the oil industry in a bad way, the oil industry is not investing enough. So this is the real problem. That's what they say. It's not that we don't have the oil. It's that the oil industry is being pushed away from investing. Well, if we go back and look at the numbers, and I always look at the numbers, when oil hit $100, the global oil industry was investing a lot of money. In 2013 and 14, it was like $1.7 trillion. That's what they invested in 2 years, $1.7 trillion. That's a lot of money, 2 years. They found 16 billion barrels of oil. Now, some of this money was also to find natural gas, but the more important is the oil. So if you kind of do the numbers, 1.7 trillion, and you divide it by 16 billion barrels of oil, it's costing $100 billion for every billion barrels you find. And I looked over the last 10 years, and that's what it comes out to be. The world spent about a little more than 5 trillion in the last 10 years, 10 years, and they found 54 billion barrels of oil. Well, unfortunately, Tom, we consumed 300 billion. We only found 54. So if you do simple second grade math, we're consuming 6 times the amount we're finding. Now, let's say we threw double the amount. If you threw double the amount we did back in 2013 and 14, we spent 3 trillion. Well, you're going to find maybe 30 billion barrels, maybe 30 billion. Well, that's exactly what we're consuming. But the issue is, if you look at the numbers, they're not investing because there really isn't the high quality reserves. That's the number one problem. And we're just consuming so much oil, because when you go back to the 50s and 60s and 70s, the least the world was finding, the least was 20 billion barrels a year. That was the least. And they weren't spending as much money because that's the low hanging fruit. And some years it was 85, 90, almost 100 billion barrels in 1 year. Last year, 2021, we found a whopping 3 billion. And we still almost spent $500 billion to find that. So that's the problem. There really isn't the economic reserves available. There is probably more, and the other issue is the Red Queen syndrome. Not only do we have to spend a lot more money to get this oil, but we have to spend a lot more money to offset these huge declines, because to grow production in the last 30, 40 years, we have gone from super giant fields to giant, to large, to less than large fields. And these less than large fields decline at a much faster rate than the super large fields. And the worst is shale, which declines 45% a year. So when you add it up all together, it's a recipe for disaster. That's why the world now is facing peak and the energy cliff, because there really isn't the economic reserves out there, Tom. And what they have to replace now every year is one Russia, 10 million barrels a day plus. every year to keep where we're at right now. And that's why it becomes impossible to do this on an ongoing basis in the future.
So, Steve, what do you mean by the Red Queen syndrome? Explain that to us a little bit more.
Well, you go back when you first discover these fields, you look at the old movies, an old conventional oil well, they drill it and there's a huge gusher, comes out under pressure. It's a very high energy return on investment. And it has a low decline rate, especially the large fields like Saudi Arabia's Ghawar field. So the big fields back in the 50s and 60s and 70s, we were producing in the 60s, 65, about 35 million barrels a day. And the decline rate was about 4% in the natural decline rate. So you're losing 1.5 million barrels a day. But then we're finding more oil and we're adding more oil. But as we're adding more oil, we're finding smaller fields offshore, which decline even faster. They're declining now in the teens, and then shale's declining 45%. So when you add it up together as an accountant, you are adding production, but the problem is the declines now. I believe the natural decline rate is 10% or more a year, 10% or more. So if it's 10%, you're producing 100 million barrels a year, that's 10 million barrels you're losing. And so the problem is when you increase the production, Tom, and again, you're adding in more of fields that are smaller, that decline quicker, it's the Red Queen syndrome. And so now we're at this 100, I call it 100 miles an hour. We're running the car 100 miles an hour, and we need to replace 10, 11 million barrels a day or more every year just to stay here. And that is going to become impossible to do that. And that's why I call the energy cliff 2025. It may be even sooner. Mm-hmm.
So, I was listening to a Twitter space the other day, and there was one of I don't know exactly who he was, but he was an analyst basically that represented the OPEC group, let's say. And he was even saying that their 2 million barrel per day cut that in some ways was looked at as slighting the US and Biden especially was actually not politically motivated. And it seems that they're in a shortfall that they can't really get out of. Is this, that very rich oil field that the world has been so dependent on, is that seeming to come to an end as well, not just the shale that we've seen in the US?
Yes, and there's been a couple of bright minds. One was Matt Simmons. He wrote a book, Twilight in the Desert, and he highlighted the problems that were happening, in Saudi Arabia and the Middle East. And what they've been doing, like Saudi Arabia was producing 10, 11 million barrels a day. And it was easy to do this, early on. But then as the fields peaked, they started doing water injection. And so now they have all these water injection wells around the outside of the field. And then they drill down in the middle of the field and it pushes the oil into the middle of the field and it comes out these wells. But you'll notice that Saudi Arabia has a lot of gas oil separation plants because there's so much oil water separation plants because there's so much water in there. And now what they're doing is their water cut is getting higher and higher and higher. So they're depleting their field now from the bottom up because oil raises in water. Mm-hmm. And so this has been a known phenomenon by many in the industry. They realize that many of the OPEC countries have overstated their reserves. And James Dietrich put a book out, Too Much by Half, where he believes a lot of these reserves out there are overstated. So I think now we are seeing that all this enhanced oil recovery, pumping in 7-8 million barrels of seawater a day to keep production elevated, is starting to get old. And so now they realize that there is only so much that they can continue. And I do believe we're going to start seeing declines coming from the Middle East. And the market is not prepared for that. So yes, I think this was a matter of time. The future is now here, and Twilight in the Desert is finally arrived.
Steve, when you're talking about how these countries in the Middle East have enjoyed basically a period where all they had to do was, in some ways, pump money out of the ground. How is that going to affect their economies that are so heavily oil dependent going forward?
Well, I think it'll be okay for a while because I think oil prices are going to remain high because, as I mentioned, when we hit an energy scarcity environment, assets you own lose value, but things you consume will inflate. And that's going to be based mostly on energy. So I think even if they lose some oil production due to the natural declines that are coming, the price could stay high. And Russia has had very high revenues, even with lower production of natural gas and oil. And so this is part of their strategy too. But as time goes on, the problem is the Middle East consumes a lot of their own natural gas. The Middle East also consumes a lot of their own oil. So they've been actually increasing their own domestic oil consumption. So it will become problematic as their oil production declines because they're going to have less net exports. And so, yes, this could impact countries over time, but their OPEC revenue, I mean, is supposed to jump to like 840 billion this year compared to 320 billion in 2020 during the pandemic shutdown. So that just goes to show you, it's not quite 3 times, but you hear that, the Middle East they have a lot of ideas for capital exploration or capital expenditures, not really in oil, some, but in other ways to transition their economies and their industry away from oil. But I don't see that working. Without oil, there's no green energy. There's no transition to another energy system, unfortunately.
Mm-hmm. When you were talking about overstating reserves, you had a breaking news item on your site yesterday about the U.S. Energy Agency hiding shale oil declines. So can you fill us in a little bit on what you found and why that might be?
Yeah, I put this report out for gold members because the EIA, the U.S. Energy Information Agency, puts out estimates of oil production. And they were saying in like the beginning of 2022 that the United States would regain oil production by the end of the year, and we would see a nice gains again into 2023. And not only oil, but natural gas. Well, they've been lowering those estimates, unfortunately, because it's very important. Energy drives the economy, and it's strategic. The United States has a strategic hold on the rest of the world because right now it's producing a lot of energy. Matter of fact, we produce about 1 out of every 5 barrels of petroleum in the world comes from the United States. That's a lot. That's a big difference than what it was 15 years ago. And so the issue is, it seems as if the EIA is overstating what the production is, these estimates, what they are, and they're going to be. Because looking at the data I get from Shale Profile, the Bakken, the Eagle Ford, and the DJ and Niobrara, they're showing actual declines. Their trends are lower. Whereas the EIA, in their drilling productivity reports, they're showing production is magically going up in the second part of the year. But I proved this wasn't happening because it goes by how many well completions, Tom. Mm-hmm. They're actually doing less well completions this year per month than they did last year. And the only way you can grow production is if you have more well completions. And so, the only place in the United States that's growing is the New Mexico Permian. Because why? They are still rapidly increasing their well completions, but Texas is actually declining. And Texas is the larger part of the Permian. So this is a very interesting dynamic. I believe shale is going to start rolling over by the end of the year and into 2023. And my forecast is we're going to see between a 50 to 75% collapse in U.S. shale production by 2030.
So, Steve, why don't we go over the equation for energy return on investment and maybe, give us some specific examples, because I think this is what most people don't necessarily understand about your thesis here. Yes,
because, there's a lot of barrels. We hear, there's Rystad and these other energy consultant companies and the IEA, the International Energy Agency, says there's 1.7 trillion barrels. We've got all these trillion barrels of oil. Like Venezuela has all this, heavy oil. So it's 400 billion barrels of that, and I've mentioned this, the Alberta oil sands, to produce the 3.3 million barrels a day of Alberta oil sands, you have to burn 3.3 billion cubic feet a day of natural gas. So you're basically turning wonderful natural gas, it's like turning into gold into lead to produce this low quality oil sands. Mm-hmm. And so the only way Venezuela oil production is going to be increased, if they want to tap into that 300 plus billion barrels of heavy oil, is they've got to ramp up their natural gas, because that's what they did in Alberta. So this is very difficult. And so when you look at these trillions of barrels of oil resources, not reserves, resources, mm-hmm. the energy return on investment is too low, because when we first started moving into oil, I mentioned this a few times, the energy return on investment was 100 to 1. Matter of fact, the discovery of oil in the 1930s was 1,200 to 1. Now it's below 5 to 1. And so now we have moved from 100 to 1 in 1930 to 30 to 1 energy return on investment. Now, this is not money. This is energy, which energy you get for what energy you invest. Mm-hmm. 30 to 1 in 1970. Shale oil is 5 to 1. Oil sands is 4 to 1. Shale oil, which is actual shale in Wyoming, there's 1 trillion barrels of that crap there. You got to crush that. You got to spend trillions of gallons of water to get that out. That's like 1.3 to 1 to get that. The problem with all of these lower energy return on investment sources, our economy, this is according to Charles Hall, our economy, our modern high-tech economy, global economy, needs about 10 or even 12 to 1 of its oil just to sustain all this. So people say, well, we're producing shale oil at 5 to 1. We're producing oil sands. Yes, but with a massive amount of debt, because we've added all this debt in the last 15 years to allow that to happen. And that can't continue. So this is the problem. If we go and try, and lastly, if we go to try to extract these trillions of barrels of lower energy return on investment oil resources, it will bankrupt the economy. Mm-hmm. That's what it will do. And that's what it's doing right now with all this debt. And so this is the process of hitting the falling energy return on investment. That's what the world is hitting. Not just peak oil, but peak high quality oil that can run the system.
So, Steve, when we look at what the U.S. is actually exporting, how much have we exported this year to kind of make up that demand that Russia has been shut out of for Europe?
Well, it's interesting, even though the United States is now a net exporter, it's of total products and oil, but we are still net importers of about 2 million barrels a day of oil, because our Gulf Coast refineries are designed for a medium grade oil. Mm-hmm. So we import a lot from the Middle East. We get a lot of our oil also from Canada, which we mix with the light tight oil to make a more of a medium grade, but it's very hard to refine that. So we are exporting between 2 and 3 million barrels a day of oil and products. That's what we are doing. We are a net exporter of that. Partly because Biden and the White House is selling about 1 million barrels a day from the SPR. And that goes into the system, that makes refined products, and then that gets exported. And we are exporting about 2.5, 3 million barrels of our shale oil from the Permian, because we'd rather have the higher quality medium grade that can produce diesel. And so we are exporting about 10, 11 billion cubic feet a day of natural gas. We're exporting some coal, and we're exporting some oil and products. But I believe this gets into serious trouble within the next several years. And in a few more years after that, the United States is going to have to be importing a net importer of products again. At the same time, other countries around the world are going to be declining in production, and they're going to need even more oil. So this is the double-edged sword that the world is getting ready to face, especially after 2025.
Mm-hmm. So with the US making up that shortfall for Europe at this present time, but the dollar also being high, how does that work for the rest of the world? And how does that end? You know, it just seems that with countries having to use the dollar like that, it in some ways seems unintentionally weaponized at that point, but nonetheless still does damage to other countries when they're forced to buy oil from other sources.
Well, we've been seeing some problems happening in third world countries. Of course, Europe, they were the first to have the problems because they're the biggest net importers of natural gas, and Asia is number two. And basically, that's it. All the other regions in the world are either even or they're net exporters of natural gas. Mm-hmm. And so Europe was the canary in the coal mine because they import so much. And so the issue is when you go to some of these third world countries that have trying to continue business as usual, they've got dollar denominated debt. When energy prices go up, the dollar goes up, the debt that they have to repay goes up, the prices of food go up. And so now it's like a triple, quadruple hammer on them. And so I call it the Pac-Man that's starting in the weakest countries. And so we have never seen, I call it the dollar and oil price. It's the bone crusher. Mm-hmm. We have never seen the oil price now it's at 85 and the dollar at 112. It's never been here before because in the past, when the oil price had been high, let's say at $100, the dollar was in the 70, 80 range. And so it tends to move in the opposite direction of the oil price. And so that's typically the case. But now you've got a very high dollar index and you've got a very high oil price. So it is the Pac-Man that's destroying these third world countries. And it's going to continue to do that, especially as oil production declines. And then it's going to move up to the next country, the next weakest country. And in time, Tom, it's going to hit the biggest countries. It's going to hit the US. It's going to hit the Western countries. And so this is how I see it happening. It's going to unfortunately devour and hurt the weakest countries first.
But as it moves up the chain, Steve, couldn't we see at some point, because of the strength of the dollar, other countries wanting to move away from using the dollar because it is so strong at this point?
You know, we are now in a place we've never been before. And in some of my past interviews, I've talked about we have used the financial system, all of it, right? The interest rate swaps, all these Ponzi assets, retirement accounts, pension plans, to kind of continue getting this, to keep the system going. And there's a lot of leverage now. There's a lot of leverage. And that only works if you can add energy. If you don't add energy, all that kind of falls apart, especially in the United States, because now the Fed and the US government is going to have to fund higher deficits. And the only way they can do that is by issuing treasuries. Well, now they're trying to sell treasuries back into the market. And so there's less buyers of treasuries. So I think at some point in time, even though we are seeing strength in the dollar, you know, I think as US oil production starts to head over and down, the world's going to say, well, the United States isn't the new Saudi Arabia. And so I think at the same time, the dollar is going to get into serious trouble. And yes, what makes sense to me in the future, I don't know how this is going to happen. The world is going to have so many financial explosions and volatility. They're going to have to move to currencies and value that's based more on energy and commodities and goods than on financial instruments like treasuries or currencies. And so I think those who are exporters of energy are going to do well, who are exporters of goods or food are going to do better than those who are highly dependent on energy imports. Mm-hmm. And I think their currencies are going to be hurt the most.
So as we're talking about Europe, Steve, let's look at the winter ahead if we can. I'd like to get your take on something that I asked Doomberg about a couple of weeks ago. And he gave us some very interesting points on the inventories of gas on hand in some of these countries. So, I've seen certain news stories that they have lots of inventory, or that their inventories are up to 80, 85% full. What does that mean to you? And do you see that as an accurate picture being portrayed, to keep them warm and having the energy that they need for this winter?
Excellent question. And I can answer it in a few different ways. Yes, it was impressive how Europe was able to increase their inventories. And overall, it's about 92, 93% in Europe. That's how full their natural gas inventories are. Some countries like Germany's 96%. The UK's full, 100%. And so they range, but most of them are 90, 93% or higher. So that is kind of a good feeling, because you burn the natural gas during the winter a lot more. And even though you're still getting some supply, you're using up inventories. But this is just one winter. We don't know how cold the winter is. The other side of the problem is Europe, Germany did a lot of things to curtail demand. They've been cutting industrial demand or production in Germany, the powerhouse of the European Union. So by cutting down production, by doing things to limit demand, and also some interesting things happen. We've got more LNG moving to Europe from the United States and elsewhere, but China got smart. They took natural gas from Russia, they repackaged it, made it LNG, and increased the price 70%, and they sold it to people in Europe. Mm-hmm. And so the problem now is, even though their inventories are at a higher level, which will help them through the winter, they have paid through the nose for it. And this is just 1 year. And what's interesting, the Dutch TTF price is now down to about $32. It hit a high of 100. And even Japan, the LNG price is down to 30. That's the spot price. But these are still 4 to 5 times higher than the 5-year average. Still 4 to 5 times the 5-year average. Mm-hmm. Now, the energy problems, the energy scarcity, the energy cliff doesn't go away next year. It's round 2. Now, if the world goes into a huge recession, God knows we have another pandemic, then all this could really destroy demand. And, for a brief period, we could get more inventories, grow, and that could save the world for a little while. But unfortunately, Tom, each year that goes by, it's going to get much worse. And I keep saying we have to look at the inventories trend going forward, because mm-hmm. the United States right now has 106 million barrels of diesel. They should be 140, 145. We're at 106. And we're producing all this oil. And so demand is not stopping enough. We're still consuming, and even our gasoline inventories are lower than they should be. So I really think the Fed is probably going to be raising interest rates in the next 2 times. Probably, I think the number I hear is 75 basis points, because then they really want to kill demand to get prices down even lower, to get demand down. Mm-hmm. And I'll conclude here. When the November elections are done, they're going to stop selling oil from the SPR. That's 1 million barrels of supply gone a day. If OPEC says, okay, we're going to get serious and we're going to take off 1.5, 2 million barrels of our production, now you just lost 2-3 million barrels of supply. Well, what is that going to do to the oil price? We could see a slingshot. So there's very interesting dynamics now taking place.
Mm-hmm. But isn't there some nuance to be understood in these inventory levels in Europe? Saying, for example, the UK, it might be 100% full, but that only feeds something like a day or 2 of demand for the entire UK.
Well, this is the issue. These inventories, because there's still a lot of LNG floating around, that's, and we hear there's a lot of LNG carriers waiting to be unloaded in Europe. It will really depend on how cold of a winter it's going to be this year. But again, they're still paying very high prices for LNG. We will know how this plays out, because the peak in the ability to increase inventories happens about the third, fourth week of October. Mm-hmm. And then they start drawing. And November and December, especially January and February. And so we will see how these inventories change. And if they're dropping faster than they did last year, then that's a sign that they are consuming a lot more. But, they're going to a little bit more coal, they're burning more wood. It will be interesting. But again, this is just the first, not even the first inning. This is just the first at bat. Next year, it's the other team. There's going to be at bat. You still got 9 more innings. And so this is just the beginning stage, Tom. Unfortunately, I do think Europe is going to be in serious trouble within the next several years.
Mm-hmm. So you mentioned earlier some of these other, let's say, third world countries that are being affected by these high energy and really dollar prices in some ways. So how are they trying to, let's take Zimbabwe, for example, how are they aiming at, quote unquote, stabilizing the economy by raising their interest rates? Is that something that you think is in some ways sustainable as well?
Well, Zimbabwe, they always do things big, right? They have, $1 trillion bill wasn't enough. They printed $100 trillion bill. So they always do things big. And, Bloomberg came out with this article showing that Zimbabwe, the government found out that the way to try to keep economic stability, they're going to keep their interest rates at 200% because they've got 280% inflation. And so this is the kind of insanity that central banks are trying to do to keep the system going. Now, Zimbabwe is an outlier, but unfortunately, I think we're going to start seeing more of this in third world countries that are heavily dependent because they're using a lot of their reserves, their cash reserves, to continue buying things, goods and energy. But these energy prices are so much higher because they're paying them in dollars, right? Mm-hmm. And so it's a disaster. And so we really don't know how bad it is because what they're doing is they're eating their feed corn. They're cannibalizing their cash reserves. Mm-hmm. So we really don't see the fireworks yet. But if we get that big turnaround in the oil price, pushes up the price of everything, right? Natural gas goes up. You got high food prices again. Then that's going to be the next stage. Then you're going to see some insane government policies of trying to figure out how they're going to manage this. Higher interest rates, higher inflation. Unfortunately, that's the reason to be in the precious metals, Tom.
Mm-hmm. Well, that's exactly where I wanted to go next, Steve, was
good.
Asking you how, let's say for the precious metals only focused side of our audience, how does any of this relate to precious metals and why does it matter to them?
Well, what I try to do is the KISS, keep it simple, stupid principle. And I figured out by a lot of research on energy over the last 3,000 years that energy has always been the driver of the economy. Always been, whether it's wood fuel in the Roman Empire, and then it was coal during the English Empire, the British Empire in the 1800s. And then we moved to oil and natural gas. And so it's always been about the energy. Well, what has been money, because all we're doing is taking energy and making food and goods and services, and we trade those. But you have to have the energy first to have the goods and services and the food. And so what has been the money of choice for 2,000 plus years has been gold and silver because they don't rot that much. They hold their value because it takes a lot of energy to produce gold and silver. So gold and silver have been stores of this energy value that we trade in the market. Unfortunately, in the last 100 plus years, the market kind of forgot about that because we brought on a lot of oil. And I've got a chart showing world population and oil production over a 2,000-year period. And it goes up exponentially. Matter of fact, the world population goes up almost the exact same way oil production has gone up, because that's how we produce food now, mostly with oil, petroleum products, and natural gas. And so the issue is when we start getting into energy scarcity, and we're just starting to see the fireworks now, it's important to be in precious metals because they store this very important energy value that is the foundation of our economy. A bond does not do that. And we're seeing a lot of problems with the bond markets now, especially the UK bond market. Other bonds are going to get into trouble. And then we're going to see the same thing with stocks. We haven't not yet seen the collapse in the stock market. And then the real estate and businesses. So if you look at something in its least common denominator, its most simple equation, when energy production declines, economic activity is going to decline. Real estate prices are going to fall. Stocks are going to lose their value because they're based on growing earnings. If you don't have growing earnings, your stock price falls. And then a bond, if you can't keep these bond markets going because they're basically IOUs, and then there's a 40 plus trillion in money supply sloshing around the world, you begin to realize the world is one giant Ponzi scheme. And unfortunately, I hate to say this, and the precious metals are a store of value because we're heading to energy scarcity. You need to transition to protect wealth. Now, metals aren't going to solve all your problems. They're not going to provide you, food in the ground, but they will protect your wealth. And the market has not figured that out yet, but they're beginning to, because you're starting to see these premiums, Tom, in the gold and silver bullion. They're hitting highs we have never seen before. And gold maples and the gold Krugerrands, which are less than the huge premiums on the gold eagles, these are now reaching the same premium levels during the pandemic shutdown and during the 2008, 2009 financial crisis. And we're not even in a crisis. We're not even in a pandemic shutdown. Wait till we have a crisis that hits. And so I think we are in the beginning stages of something really big in the precious metal market, and investors are just starting to wake up.
So Steve, on maybe a more macro level, how is this going to affect countries that hold a lot of precious metals as well? Are they going to have the ability to get the energy that is available, or let's say the excess capacity that is available?
Well, to me, that makes common sense. That makes common sense to me because at some point in time, we know all fiat currencies lose all their value because it takes $1,500 to produce 1 ounce of gold. And it takes about $2.50 to make 15 $100 bills. But you could make those really cheap. You can make those probably for a few pennies. And so why does gold hold its value? Because the energy that it took to create that gold coin isn't equivalent at all to the energy it took to make a $1,500 worth of bills. And that's what it comes down to.
And it's even cheaper just to add a couple zeros to a keyboard, right?
It's cheaper just to add a couple zeros. And you know what? This is how the world has worked because we brought on oil and it was more efficient to use digital dollars, cross-country, global trade. It was easier. But that only worked with growing energy production. Now you've got all this money supply out there, and it's grown due to the debt and all these assets. And the reason why they're a Ponzi scheme, Tom, is there isn't the energy to back them up. And that's why they're a Ponzi scheme. It has nothing to do with the loss of faith. When the market goes, wait a minute, we don't have energy to do all this. That's when the market wakes up, the psychology changes, and all those asset values really start to collapse because there isn't the energy to give them value, especially currency. And so, yes, I think over time, the market is going to start to refigure out. I don't know how it's going to be done, but those who are holding on to physical metals are going to be holding on to the real collateral, the real store of wealth and value, because what are they storing? Energy value. A bond is basing its value on energy burned in the future. And you do not want to be holding those IOUs. And I keep saying that, but I think more and more people are waking up to that message.
Mm-hmm. Steve, is there anything else that's maybe top of mind that we haven't mentioned yet that you think is worth talking about? There's so many things that are going on right now. What is catching your eye lately?
Well, I do believe the last thing, and to make people understand, there's two different precious metal markets, because a lot of precious metal investors look at what's happening with the ETFs and they all look at that as manipulation. I don't look at it that way. I look at the institutions, hedge funds, large net worth investors. This is where they play. If I want to call up and buy 100 silver eagles, that's what I do, or a couple of 100-ounce bars. That's how I play the market. Institutions, they say, okay, I want to put 50 mil in silver. I'm going to go into the iShares. They're not going to call up a dealer and ask for, 10 million silver eagles. It doesn't function that way. And so there's two different markets. And because the institutions are seeing exactly what the Fed and central banks are doing, trying to destroy the economy to bring inflation under control, what is their knee-jerk reaction? Well, we're just going to ease up on gold and silver because that's what a recession does. It lowers energy prices, it lowers commodity prices. So we can't blame the institutions and large investors and hedge funds for doing this because this is what makes sense to them. But really, they should not be doing that. The problem is when they try to get back in. And so on the other side, you got the retail bullion market, even the refining market, and there's shortages there because the diehard investors see lower prices, know there's a lot more problems coming, especially with energy. And we're getting new investors that have never bought precious metals. They're starting to buy. So we're seeing a lot of demand and there's shortages, high premiums. But when the institutions and large investors and hedge funds start to understand these big problems coming with energy and how it's exploding the financial system, they're going to be moving back in. And when you've got both moving in at the same time, that's when we're going to see a precious metal market like the world has never seen before. And so I don't mean to hype that, but that's what's coming. And I think it's only a matter of time, and we'll know if we continue to watch the energy. That's why I focus on energy to my subscribers, because if you see what's happening with energy, it's the leading factor that's causing all the financial problems and geopolitics in the world.
Mm-hmm. So what do you think will be some of the first signs of, let's say, institutions or bigger investors starting to realize that they don't want these paper products and start moving into the physical products?
Well, I don't know. You see, you get very smart people and they'll say, well, I just want to get physical metal and put it in a vault outside the system. But, managers of institutions are just like people. When they see, oh my God, like in the pandemic shutdown, we got to get into silver. We got to get into gold. They go into the ETFs. So it's a matter of education. But I don't see that as a bad thing. Of course, it's probably wiser for institutions who understand these dynamics to slowly, quietly acquire metal, take it off of the exchange, take it out of the ETF, put it in a separate vault somewhere. And that may be happening right now because we're seeing a drawdown in the LBMA. A lot of this is going to India. That may be a smart thing, but it's even a good thing if institutions go, holy, I got to get into the ETF. Because at some point in time, what JP Morgan warned us during the Wall Street silver squeeze, they're not going to be able to get the silver. And that's going to be front page news on CNBC, because then you're going to see the ETF premiums shoot up well ahead of the spot price. And that's what's going to drive the price. It's going to be very, very interesting. So I think it's going to be a combination of things. But again, the UK gilt market and the British pound having a hemorrhage is just the first sign in the Western economy. It's just the first. We're going to have many more of those. And pretty soon, these very smart folks who run these institutions, some of them are going to say, we need to get out of this crap. Just like on the Margin Call, that famous movie where they figured out we need to get out of this crap before everybody else does. And that's exactly what they did. Mm-hmm. And we need to get into the real assets. I see this playing out again. I'm not quite sure the timing of it, but it just gets stronger and stronger as time goes on. And these high premiums, even though they can come down, I don't think it's going to get better because the energy is going to get much worse.
Mm-hmm. Interesting. Well, as usual, time will tell what's going to happen and where some of these problems arrive first. But I appreciate you sharing your opinion with us today and showing us, hopefully spreading some light on some of this stuff and explaining it a little bit more clearly to anybody that might not understand the importance of some of this stuff. Steve, I really appreciate your time and your generosity with your knowledge today.
Thanks, Tom. And one last thing, I don't mean to be hype, but when you look at Tesla and how Tesla went from, $20, $30, $40, and then the thing just blew up. It went up, it reached $1,000. And you say, well, why didn't I invest in Tesla back then? Because it's so easy to see that. I think we're seeing the same thing with the silver market. Because right now, why the heck would I want to be in silver in the low 18s? But unfortunately, the world doesn't understand these huge problems that are coming. And so it's kind of like, why would I want to get in Tesla? I'm not saying Tesla's valuation was worth it, but I think that the same dynamic is going to play out in the precious metals. Because there's only 1.5 billion ounces of gold that institutions, hedge funds, and large net worth investors can get their hands on. And at $100, that's 150 billion.
Yeah.
This is the problem. There just isn't the silver out there or even the gold. So actually, there's less silver. There's not that much more silver than gold. So I think these are the important dynamics we're going to see play out. So thanks again for the chat, Tom.
Thank you, Steve. And of course, if anybody wants more of your info, you're available on Twitter at SRSrocco Report and, of course, SRSroccoreport.com.
Yes. Thank you very much, Tom. And hopefully we can do this again sometime after the winter to see how things are playing out.
Of course, Steve. We'll get lots of updates from you. Looking forward to it.
Thank you, Tom.
Take care. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.